Hi, everyone. Welcome to the ASCO webcast on remaining challenges in benchmark transition 2021 and beyond. Today, we'll discuss the benchmarks reform, which continues to be on top of the global regulatory agenda. Particularly, transitioning away from LIBOR to its alternatives is one of the biggest changes and challenges financial markets have ever seen. And the reason for that is the fact that systemic rates like LIBOR are deeply embedded into the financial system for long years across a wide range of products and use purposes. To give an example, systemic rates like LIBOR are used for trillions of dollars of derivative products, cash products, retail consumer products, as well as for other purposes such as taxation, valuation, and accounting. Systemic rates are also used for different financing purposes such as trade finance or infrastructure finance. And to give you an idea about the size and footprint of the issue, according to US regulators' recent statement, today we have $223 trillion contracts that reference only US dollar LIBOR. And that figure equals to 2.5 times the global annual economy. And that is perhaps why today there has been substantial public and press attention on the benchmarks reform. So we'll discuss all the important steps in the benchmark transition, what has been done so far and what is pending to be done. And our speakers are actively involved in various pillars of the benchmarks reform, and they have very important responsibilities in this respect. So we were lucky enough to bring a very prominent lineup today. Let me introduce them. We have Arthur Yuan. Arthur is the Deputy CEO of the Hong Kong Monetary Authority. He is in charge of the full range of banking policy, supervision, conduct, and enforcement issues at the HKMA. He's also leading, importantly, FSB's work on the progress report to the G20 leaders. And we also have Scott O'Malley, who's a well-known figure in the securities world. Scott is the chief executive of the International Swaps and Derivatives Association, and he has been performing that role since 2014. And importantly, again, is involved one of the most important pillars in the benchmark transition reform, which is on contractual robustness and fallbacks. And since 2016, they have been leading this work. And then we have Anne-Laure Condat. Anne is FCA's manager of the benchmarks policy team at the FCA, and it's quite important because, as you know, FCA is the regulator of LIBOR, and they are leading the global regulatory efforts with the US regulators and our European colleagues, and they are very actively involved in benchmark transition, given that LIBOR resides in London, as well as some of the other systemically important benchmarks. We also have Simonetta Iannotti from the Financial Stability Board. In her current role, Simonetta is the secretary of the FSB's official sector steering group, again, as I said, which is leading the work on benchmark transition. She also supports the Standing Committee on Supervisory and Regulatory Cooperation, which is also involved in the benchmarks reform. And yes, basically, Simonetta is responsible for FSB's benchmark work. Before moving ahead with our questions, I'd like to set the stage a little bit. I think it's necessary to understand why the benchmarks world was captured with a monopoly of certain interbank lending rates. This is necessary to diagnose the root cause of the problem. How did we end up here, basically? And the reason for that is the fact that while bank funding models have been evolving rapidly and the derivative markets have been growing drastically, the activity in the underlying unsecured interbank lending market has declined substantially. And as a consequence, a significant divergence has occurred between the activity in the underlying interbank lending market and the overlying markets, those derivative and cash markets that reference systemic rates like LIBOR. And to fill this gap, we needed more and more expert judgment and governance. In an environment where the volume of contracts, for example, in the underlying, say, 6-month LIBOR is 1,000 less than the activity in the overlying market, it is very difficult to say that that benchmark is representative and sound. And inevitably, that benchmark would be vulnerable to manipulation. For the future, whatever rate we use, we should avoid that inverted pyramid problem and make sure that it does not happen again in the new alternative rates. We know that there's some discussion on the credit sensitivity issue, and competing rates are coming into the market together with SOFR, and I think that is something that we should keep in mind. Basically, the bottom line here is that the benchmark should be representative of its underlying market, and secondly, and importantly, it should behave as expected during times of stress. So we have also had some issues with LIBOR during the COVID-19 crisis. Of course, one can argue that the use of same reference rates to price financial contracts facilitates standardization, it reduces transaction costs, it enhances liquidity, and probably market participants are attracted to the fact that markets and products that reference IBORs are deep and liquid, and they're easy to transact in. But that being said, a high concentration of contracts that are linked to the same reference rate may also create systemic disruption, and we may result in rates that are deeply embedded in the financial system. And such benchmarks like LIBOR might be too big to quit, and they may pose risk to overall financial system, and importantly may hamper investor confidence in financial markets. So very briefly on where we are now, just to set the stage also, 2021 is a very critical year in benchmark transition. Especially the 5th of March was probably the most important date since the beginning of the benchmarks reform. And on that date, the FCA and ICE Benchmark Administration, LIBOR's administrator, have confirmed the end date for various LIBOR panels. So for US dollar LIBOR, this is mid-2023, and for other 4 important currencies, it's going to be end of this year. The end June 2023 date for US dollar is to support the rundown of legacy contracts. So the major volume of contracts that reference LIBOR are concentrated in that currency. So now the FCA's announcement removes any uncertainty regarding LIBOR cessation, and it established firm expiration dates for all LIBOR panels. It also triggered the fixing of spread adjustments, which will be used in fallbacks. And transitioning away from LIBOR requires very significant commitment and sustained effort, both from the financial firms and non-financial firms, be it in LIBOR jurisdictions or non-LIBOR jurisdictions. And there's a very clear expectation that the market participants must act urgently with the tools available in hand. This year was very important, as I said. Another key date was the 25th of January, where ISDA fallback supplement and fallbacks protocol became effective. And these ISDA tools, as a big bank style transition tool, they ensure a viable safety net in the event that an IBOR ceases to exist or it becomes unrepresentative. And I think one key message here is we should stop writing new contracts. IOSCO and FSB published important statements early in June. If we find ourselves in a hole, we should basically stop digging. Or if there's a hole at the bottom of the pool, we should first fill that hole so that we don't really increase the notional volume of contracts that reference LIBOR. This is very critical. And of course, the tough legacy problem is very important. It is not only about steps to stop issuance of new products linked to LIBOR, but also at the same time, we should make effort to transition away from LIBOR and legacy contracts wherever feasible. We call it as the tough legacy problem, as Andrew Bailey labeled a couple of years ago. And one critical challenge in the transition is, of course, cash markets are lagging behind derivatives, and some of the products that reference LIBOR are very difficult to negotiate. And there's an expectation from the financial industry for term rates that are derived from risk-free rates, which continues to be a hot discussion. And we are lagging behind in cash markets. I think we have to accelerate there. And another critical issue is emerging markets lagging behind developed economies. We know that today there are more than 100 jurisdictions that heavily use US dollar LIBOR. And until very recently, I think the awareness and consciousness about the end of LIBOR in those jurisdictions were quite low. And we are making a lot of effort as IOSCO through our outreach program, which we launched in 2019. And finally, I think monitoring progress on LIBOR transition closely is critical in the context of international coordination, where various agencies and international standard setters are coordinating on supervisory and regulatory issues, and they are trying to set globally consistent expectations and milestones, as well as messaging. With all this background information in mind, let me now turn to Simonetta first. Simonetta, as I mentioned, it would not be wrong to say that 2021 was the most critical year in benchmark transition so far, with various key milestones, some of which we have already mentioned. This also makes this year's progress report very important. The progress report was published on July 6th and submitted to the G20 leaders. Can you tell us, please, what are the key messages from the progress report?
So thank you, Alp. Yes, sure. So The FSB, as you mentioned, just delivered this progress report to the G20, and it has been published on the FSB website on 6th July. It's an important report and which is specifically dedicated to LIBOR transition issues. So the report examines what are the recent transition developments, the main supervisory issues that have been identified in relation to transition, and then the next steps for international coordination. As you mentioned before, Alp, the LIBOR end date has been confirmed earlier this year. So the majority of LIBOR panels will cease at the end of this year, although a number of key US dollar settings will continue until mid-2023, but we know this is to support the rundown of legacy contracts only. So there is no remaining doubt on LIBOR fate. And hence the FSB has urged action on the part of authorities and market participants, financial and non-financial institutions alike, to complete the transition away from LIBOR by end of this year. This is the main message of the report. In general, to support and to further expedite the transition progress, the report puts forward 4 key messages. First is for supervisory authorities. So supervisory authorities in all jurisdictions, not just LIBOR, should step up their communication effort in order to increase awareness on the scope and urgency of relevant IBOR transitions for all clients and other market participants. So Arthur will speak about the identified supervisory challenges that we have delineated in the report in more detail. The second message is for financial institutions and non-financial institutions that need to accelerate adoption of risk-free rates in new contracts, accept newly developed products, as well as accelerate an active conversion of legacy contracts to either directly reference risk-free rates or to insert robust fallback language. The third message is related to the remaining challenges to transition. As you noted, Alp, the report has highlighted 2 main areas of concern where transition is further behind. The first challenge is about loan markets, where much new lending remains linked to LIBOR. This increases rather than reduces the stock of contracts affected by LIBOR discontinuation. Loan markets are slower in general to adopt risk-free rates, and this is especially so for multi-currency syndicated loans, which have a tendency to move at the pace of the slowest member of the syndicate. So the report reinforces the message of a statement issued by the FSB in June that market participants should move, should not wait, must not wait for development of additional tools, in particular should not wait for the development of forward-looking term risk-free rates. The second challenge to transition is about emerging market and developing economies, which are generally less aware, less prepared for the transition. Indeed, some emerging markets and developing economies reported that engagement with financial institutions regarding transition planning has not yet started or started only recently. So the message there is for the authorities in these jurisdictions lagging engagement with financial institutions. They should stop efforts to increase their outreach in order to raise awareness and promote action. The FSB will also do its part here to support transition in MEDs through its regional consultative groups. The fourth message is about international collaboration and coordination, which remains crucial in expediting the transition progress. FSB members will be reiterating the expectations that regulated firms seize new use of LIBOR as soon as practicable and with reference to the relevant milestones in each currency, and no later than end 2021. The message, however, probably most straightforward, but also most important in the report, is that market participants should not continue to enter into new contracts reference US dollar LIBOR beyond end 2021. And this is the reason behind the intention of the FSB to launch another exercise to monitor LIBOR transition progress in mid-2022. Let me stop here, Alf.
Thank you very much, Simonetta. As we clearly understand from the core messages of the progress report, our time is running out, and the regulatory expectation is that market participants must act urgently with the tools available in hand. And we have very limited time, and there are all sorts of details that firms need to figure out within this period of time. Let me now turn to Arthur. Arthur, as I mentioned, you have been leading the FSP work on benchmark progress assessment, and we've very recently published this year's progress report, and there are very important assessments and evaluations as well as expectations in the new progress report. So can you please a little bit elaborate on what are the key supervisory challenges based on your findings? And are there any vulnerability areas that remain uncovered? For example, what are the remaining aspects in benchmark transition, and what needs to be done in terms of increasing awareness in the markets? I think this is probably the big question as regards to where we are currently, but it would be great if you could summarize all of your findings.
Yeah, thank you very much, Al, for the questions actually. But let me, before I answer those questions, let me first of all lay out the foundations for my remarks. My observations and remarks are really drawn from the FSB reports to the G20 on LIBOR transitions that's published on the 6th of July. This is actually a follow-up report to the first report published in July last year, also an FSB report on LIBOR transition issues. So this one published on 6th of July is actually a follow-up to the first report published last year. In preparing this latest follow-up report, we have actually conducted a survey of 96 jurisdictions in the earlier part of this year. Out of the 96 jurisdictions, 51 of those responded to the questionnaire survey. We will come back to those numbers later on because it actually, if you look at the numbers, analyzing those numbers, it actually gives you a sense of some of the messages in the report itself as well. Now, I hope you asked about supervisory challenges. Actually, the report covers a range of different issues. The awareness of financial firms, the preparedness of the financial firms. But it's right that you asked about supervisory challenges because there are maybe two supervisory challenges that we have highlighted in the report and which I think would be helpful to share with the audience. The first one is actually a lack of insight into non-regulated clients of financial institutions. Now, a lot of efforts have been put into making sure the financial institutions are aware of the need and the urgency of transitioning out of LIBOR. But what we have seen in the past year or so was an increasing awareness that perhaps among the non-regulated clients of the financial firms, in terms of awareness, is still quite low. And there is a chart in the report that I refer to, I think it's graph 3 in the report, showing the different groupings of stakeholders in terms of the awareness of the situation and the preparedness. And non-regulated entities are actually, non-financial institutions are actually quite low in terms of the awareness. And non-regulated clients in particular, you can expect them to be not as aware of the situation as regulated financial entities, with which the supervisors have been working very closely for some time now in terms of pushing ahead with this transition process. So that's the first issue about lack of insight into non-regulated clients of financial institutions. The second issue in terms of supervisory challenge is a lack of transparency in terms of the external systems adopted by financial firms and non-financial institutions, in whether those systems are actually adequately prepared for LIBOR transition. Those systems are provided by vendors, and we're not sure yet whether those systems have been adequately adapted to, for example, execute contractual fallbacks or to cater for new products that are referencing new risk-free rates. And without those certainty, there is a possibility, there's always a possibility that financial firms have to find themselves doing a lot of manual sort of processing in the end if those systems are not supporting those kind of fallback or new products. And those two are the major challenges that we have highlighted in the report. Now, there are also other vulnerabilities, remaining potential vulnerabilities that we have highlighted in the report, and I would just name two here. The first one is in relation to potential inconsistency in supervisory expectations and implementation milestones adopted in different jurisdictions. This is particularly an acute issue for financial firms operating in different jurisdictions. If we do not have highly coordinated supervisory expectation or implementation milestones, then it makes the implementation efforts of those firms much more difficult to track. The other problem with supervisory expectation and implementation milestones is if they apply differently to different product types, it could actually introduce basis risk for financial firms. And also in certain circumstances, it could actually make the hedging ineffective. And so there are risks involved in terms of an uncoordinated approach in terms of setting these supervisory expectations and transition milestones. Now, I have to say that on a bilateral basis, different jurisdictions are already talking to each other, but I think that is perhaps an area of vulnerabilities that we need to sort of talk a bit more to each other in coordinating our milestones and plans. A related issue to that is, Alp, you mentioned in your opening remarks about this confirmation that for most US dollar LIBOR tenors, it would finish or it would end in June 2023. Now, in talking to the stakeholders, we have actually heard that, oh, that's great because it gives us more time to work on the legacy contracts. But we've also heard some stakeholders saying that, oh, that gives us more time to manage the whole process, including writing new contracts. Now, I think this is very important issues about supervisory expectations that we need to watch out for. That really, I think globally, we have to coordinate our supervisory expectations to make sure that firms would no longer write new contracts based on LIBOR after end 2021, and not looking at the end June 2023 as a target date for that. The reason being twofold. First, we should not perpetuate the situation by writing new contracts based on LIBOR after end 2021, because the more you do that, the bigger the size of the outstanding contracts that we need to deal with in the run up to end June 2023. A bigger problem is if we continue to do that after end 2021, that makes the liquidity in the alternative reference risk-free rates much smaller. And that actually then induces more firms to continue to focus on LIBOR rather than alternative risk-free rates. And that becomes a kind of a vicious cycle in itself. So we should actually break that vicious cycle by making sure that our supervisory expectation is clearly stated to financial firms that after end 2021, please do not write more new contracts based on LIBOR. So that's supervisory expectations. There's a remaining challenge. The other one's legacy contract. You also mentioned legacy contracts as some top legacy contracts difficult to deal with. In particular, in the cash markets, like syndicated loan contracts, which might take the agreement of a large number of parties to change the terms of those contracts. And I think that is an area that different jurisdictions are still mapping out their approach in dealing with it. Some jurisdictions decided to go for a legislative route, others decided to do other means. But that nonetheless, that is an area that I think going forward, we will need to watch out for the legal uncertainties involved. But overall speaking, I think by now, different jurisdictions, I think it's fair for me to say that compared with the same exercise last year, we have actually observed that different jurisdictions are now much more aware of the situation. And to a certain extent, different jurisdictions have progressed somewhat in terms of the preparedness as well. I just think that going forward, one of the really top priorities is to make sure that non-financial firms' awareness of this issue and their efforts to progress with the migration or the transition can be accelerated. So I strongly encourage and urge authorities to work more closely with each other as well as with the industry, and to make sure that the industry would put in efforts to educate the clients about the urgency and the need for really progressing with the migration efforts. Thank you.
Thanks very much, Arthur. These are very, very useful insights. I think that brings the issue to my initial remark on benchmark transition reform being one of the biggest changes, right, in the financial markets. There are all sorts of details firms need to cope with, like including the IT infrastructure. It looks like a detail, but when it comes to real life practice, that's a really very big issue. And I know from, for example, globally systemically important banks that they need to spend tens of millions of dollars for these, IT structure changes, and that should be much more difficult for in the case of smaller firms. And as you rightly mentioned, that network effect issue is also very important. Like, unless the alternative rates take up and they have enough liquidity in the underlying market, we won't be like, it's like telecommunication companies, basically. The more people use, the more effective it becomes. There's a similar situation. I think we will get there, but it may take some time with a lot of challenges. But we're making a lot of effort on that. And thanks very much. And again, these are very useful insights. And let me now turn to Anne-Laure and talk a little about the UK angle. And UK is I think by far is the most advanced jurisdiction in benchmark transition. And the main reason for that is probably having SONIA, which is a well-established benchmark for long years, and there's an active market, quite liquid market on that, even enough to come up with term rates derived from the alternative rate. And Laura, my question to you is basically, and you're as the regulator of LIBOR, now that the end dates for LIBOR panels are clear, as a general question, what is the expectation from the market, and what should firms do? And regulators also should focus on, including all the legacy transition issue, and all those details. It might be a little bit complementary to what Arthur is saying, but I think it's important to give this, big expectations and what is pending to be done in the near future.
Absolutely. Thank you, Alp, for your questions. And a little bit like Arthur did, I'll go back to a few months back, and specifically the 5th of March 2021, when, of course, we made the important announcements that provided certainty on when the LIBOR panels would cease. That's obviously the end of this year for sterling, yen, euro, Swiss franc, and the lesser used Donald panels. And it's a little bit longer for some of the more widely used dollar settings. But as Arthur says, it's very much for legacy contracts only. This was a much anticipated step on the path to the now certain end of LIBOR. And to reiterate the key message, there is now really no reason for firms to delay any of their transition plans. I appreciate that much of the audience will be either representing or supervising firms that have larger exposures in US dollar. So before I go into the UK progress, I just want to reiterate some of Arthur's important remarks about the fact that at first glance, it looks like US dollar LIBOR will go on for longer, but how important it is to emphasize that the additional 18 months for US dollar LIBOR is absolutely intended for existing, or what we call legacy contracts. And US banking supervisors have issued supervisory guidance that their firms are expected to stop new use of dollar LIBOR at the end of the year, or indeed as soon as practicable before that date. And of course, the FSB and IOSCO and other authorities have also issued similar statements and communications. So just reinforcing Arthur's point about the importance of that unified approach, given the international use of dollar LIBOR. And we at the FCA have certainly been very clear in what we expect our firms to meet this deadline. We are also planning to consult on actually using new powers that we are being granted to provide further legal backing to this position in the UK. So it wouldn't be just supervisory expectation, but actually in our rules. I think it's important to draw on Arthur's point as well about building the liquidity in the alternatives. And just to mention very briefly, the CFTC is leading an important initiative to build liquidity in SOFR derivatives ahead of the end of the year. It's through its Market Risk Advisory Committee, which has recommended a best practice for switching interdealer interest rate trading conventions from US dollar LIBOR to SOFR. And the date is 26th of July, which we as UK regulators are also supporting for participants in the UK. Now, having made those remarks about US dollar, which is obviously probably the largest use for everyone here in the audience, looking beyond, it's really evident from your remarks, Alp, and from Arthur's remarks that LIBOR transition has remained overall a priority for the FSB, the G20, and IOSCO throughout the COVID pandemic. And we have continued to see progress made in those unprecedented times. An obvious success story has obviously been in the derivatives market, where we have seen a large take-up of the ISDA protocol. And thanks to the work of Scott and his colleagues at ISDA, the work on fallbacks has established clear consensus for calculating a fair replacement rate for LIBOR when the panels end, using compounded risk-free rates plus a fixed spread adjustment. If we add to this all of the new SOFR and SONIA swaps contracts under the new ISDA standard language, plus the cleared pool of derivatives that will also convert to RFRs when the panels end, it's very clear to see where the swap market liquidity will end up. And I'm sure Scott will say more on this in his remarks. In the cash market here in the UK, the bond market really led the transition. And for some time now, new floating rate notes have referenced SONIA instead of LIBOR. It's important to remember that it's a market that was initially seen as incompatible with backward-looking rates, and it demonstrates how far we've come. Lending markets, as you mentioned, have a bigger challenge to face, and the target in the UK was to cease all new sterling LIBOR lending by the end of March this year. The regular data that we get from banks confirms a smooth transition to compounded RFRs for new loans. On the legacy front, many firms have also actively been able to transition their existing LIBOR exposures to SONIA in both bond and loan markets, which shows this can be done. But there's more to be done, especially on the legacy front. And clearly, the focus for market participants now should be on converting all legacy contracts for all currencies where LIBOR panels are ending. So the main message I hope you take away today is really that the time to act is now. We are conscious that there are obstacles and they vary depending on the business and the type of contract. Some can be easy wins. For example, in derivatives, if you haven't signed the ISDA protocol yet, you still can. And we appreciate that changes take time and effort, but I think we can all agree that we'll all benefit from stronger, better markets based on robust alternative rates. And there are plenty of resources out there from national working groups, the FSB, IOSCO, and trade bodies that can help you, your firms, and their clients to navigate the transition.
Right. Thanks very much. And Laura, just maybe if I may, I'd like to ask a follow-up question, if you can very briefly answer to this one, because this is important. You know that there's also an expectation from cash markets regarding forward-looking term rates, and the lack of credit sensitivity in alternative risk-free rates continues to be a hot debate. I mentioned that at the beginning. So what is your view as the FCA on the use of forward-looking term rates? And particularly maybe a sensitive question about alternative rates coming into the market to address this credit sensitivity issue, and they're competing with SOFR basically. Is this something really we want as regulators?
Thank you, Alp. I think this is a really important question, and it's as much at the heart of transition as the transition more broadly away from LIBOR is what is it that the market will transition to. First, looking at forward-looking term rates, we've been clear all along that we expect markets to predominantly transition to the relevant overnight risk-free rates, whether compounded or averaged. because these are the most robust versions of the IFRs, and they have many benefits for users. But that said, we also appreciate that there will be some circumstances, specifically in niche parts of the cash markets, where overnight rates may not be fit for purpose. And this is where alternative benchmarks, such as forward-looking term rates that are based on risk-free rates, can be useful for a limited set of scenarios. There's obviously some FSB guidance on this topic, which is really helpful to look at. In the UK, to provide some idea of scale, our national working group, the Sterling Risk-Free Rate Working Group, has concluded that for 90% of sterling loan market by value, SONIA compounded arrears would be appropriate and operationally achievable. But that for the remaining 10%, it may require alternative rates, such as a term rate, but also it can be a fixed rate or Bank of England's base rate. So that's for the term rate. Now, your question was also about those alternative rates coming to the market. In some jurisdictions, there's been, and there's still a debate about these so-called credit-sensitive rates as a replacement to LIBOR, with some recent developments in the US in particular. In the UK, authorities and markets have been clear that these are neither wanted nor needed. Indeed, Andrew Bailey, Governor of the Bank of England, but also we've seen Gary Gensler, Chair of the Securities and Exchange Commission, and also the FCA have made public remarks to warn about the risks embedded in these so-called credit-sensitive rates. We say so-called because they're actually derived from transactions in commercial papers and certificates of deposits, and it means that, as you said, Alp, in times of stress, they're actually more influenced by liquidity rather than credit. So they can behave in a volatile manner when there are liquidity problems in the market, such as in March last year. And they carry significant risks for people who are paying such rates. So it's important that overnight risk-free rates are the common anchor point for all jurisdictions involved in benchmark reform initiatives, in line with the FSB's recommendation. Because I think what we want to avoid, you mentioned, Alp, in your introduction, this inverted pyramid issue, which sometimes we also have the other image of an elephant walking on a tightrope. We want to avoid seeing a large number of transactions moving to benchmarks that are based on small underlying markets, like we see in LIBOR today. And I think after all the work we have all done from the official sector and the markets over the last few years, I don't think any of us want to be repeating the exercise of LIBOR transition all over again.
Right. Excellent. I mean, there are very important messages in your remarks, and it's very good to hear these from the FCA as clear messages to the industry especially, and thanks very much for that. Now, Scott, turning to you, or turning to the success story in derivative markets, and Laura and I put it that way. So I think recently it was around 14,000 firms that signed the ISDA documents, which looks like a big success story, really. And I mentioned at the beginning that there are $223 trillion contracts based on the statement from the US Feds, and 170 trillion of those contracts are derivative contracts, which is by far the biggest chunk or volume of contracts that reference LIBOR. And I know that it has not been an easy way. You tried to find answers to some of the very difficult questions, like those term risk premium or credit risk premium kind of things. But ISDA protocol and supplement as a big bank style transition has been very important as the core pillar of this benchmarks reform. You had a lot of consultations on different sensitive issues, and also things like examination from U.S. Department of Justice on from the antitrust perspective, and all those relevant difficult details. Can you please a little bit elaborate on these issues? How you came to this point, but more importantly, what is still pending to be done in the derivative markets?
Thank you, Alp. Those are all great points, and it just gives you a perspective of how big this challenge is. It is a global challenge, and certainly we want to make sure that our audience today understands everybody's involved. I think you mentioned there are over 100 jurisdictions tied to US dollar, and those cross-currency swaps are certainly impactful. It's a massive challenge, as you highlighted, over $200 trillion tied to derivatives alone. These are very long-term contracts in many cases, so they have a very long tail risk. And it's super important to make sure that we have a proper safety net in order to facilitate the transition and the trading to these new risk-free rates that Anne-Laure kind of highlighted and talked about the importance of having good, deep, and liquid markets. We have to make sure that we can successfully leave IBORs to be able to get to their new risk-free rate. So that's really important. And as you mentioned, we've been working on this since 2016. We were asked by the FSB's Official Sector Steering Group, which there are over 30 jurisdictions, regulators involved in helping move forward in the transition. And we took on that challenge. And it was only through a lot of work working with both the official sector and the market to come up with the proper fallback methodology. Now, we're really proud of the work that has been achieved thus far in terms of identifying how we're going to deal with a fallback that replicates your existing IBOR contract in its commercial terms to minimize that disruption for what market participants signed up for. But at the same time, it's not going to be exact. So we really worked hard to make sure that fallback methodology was the least disruptive possible. And again, we want to tie it to the risk-free rates to make sure that transition and the expectation that people will be trading these products going into the future. Maybe I'll touch on it a little later on, but the idea that people have to think about the preparations and the operations specifically, changing your legal contracts, changing your operations, changing your risk parameters and systems to think about trading a new rate that is based on an overnight rate. So the big part about this, and let me just touch on kind of the protocol itself. We released this in January 25th of this year. It was after extensive discussions, including with antitrust authorities, to make sure that everybody was comfortable with this, that it did not pose any monopoly or threats there. So we have proper buy-in from the antitrust authorities on a worldwide basis, not to mention kind of the market regulator support as well. Now, since publication of this document back in January 25th of this year, as you noted, 14,200 entities from 85 jurisdictions have adhered to the protocol, which means those counterparties voluntarily agree to change the contracts from the IBORs to the new risk-free rate with that spread that was mentioned earlier. Now, this is really a safety net, just to make sure that all of those long-term contracts and the massive amount of contracts that you referenced have a proper fallback in place. So in case that something goes wrong, when the IBORs are deemed non-representative or no longer published, that your contract will not be frustrated. You will have a price that you can reference in your contract, and there will be zero disruption whatsoever. Now, the good news is, as a result of this massive uptake, the FCA has said that over 85% of the non-cleared interest rate derivatives in the UK referenced contracts to Sterling LIBOR now have an effective fallback in place because both counterparties have adhered to the protocol. We've heard similar numbers from the US as well, which is the largest jurisdiction and deepest market. Now, we've already heard that we have certainty on which and when the 35 LIBOR settings will cease to become non-representative, which means we now have more information about when the fallback rates will apply for LIBOR derivatives, and this should help in that transition. The spread adjustment is meant to reduce the chance that contracts will significantly diverge from the counterparty's original expectation, as I mentioned before. And the spread is fixed at the point that the relevant administrator, in this case mostly the FCA, announces that its settings will be non-representative. And as Laura mentioned, that occurred on March 5th. Now, that triggered the setting, and the fixings were all available when that announcement was made. And those spreads are available on the Bloomberg website, who is our partner in publishing the fallback methodology. Now, the fallbacks themselves will automatically take effect for remaining contracts referencing Euro, Sterling, Swiss franc, and yen LIBOR on the first London banking day on or after January 1st of 2022. And for outstanding US dollar contracts, that will happen on July 1st, 2023. Now, these fallbacks are triggered based on either the cessation or non-representativeness, so they will apply on the expected dates, even if a synthetic LIBOR or relevant currency or tenor is published after that date. So to help with some transitions, those fallbacks will be fixed and will be in effect. So now with those fallbacks in place and with that methodology ready to go for your legacy contracts, market participants can now press forward with the transition with the knowledge that they have a workable and safe backup that will take care of all of their derivative exposures if they've adhered to the protocol. And if they haven't adhered to the protocol, we certainly welcome them and can make that available, and they can certainly sign up today if necessary. Now, the fallback protocol and the IBOR fallback supplements we're also working on fallbacks in Singapore for SOAR and in Thailand. We have, which are synthetic benchmarks that use US dollar LIBOR as an input. These benchmarks will fall back to an adjusted version of the rate with an adjusted SOFR compounded in arrears plus a spread as published by Bloomberg as an input. Now, later this year, we will publish a second IBOR fallback protocol and a supplement to implement fallbacks for certain regional IBORs, including NIBOR in Norway, BKBM in New Zealand, as well as two other synthetic benchmarks that are tied to US dollar LIBOR as an input in the Philippines and in India. Now, neither the New Zealand or Norway are expected to cease in the near terms, similar to other regional IBORs that are covered by the existing IBOR fallback supplement and protocol, including Euribor in the EU, BBSW in Australia, HIBOR in Hong Kong, TIBOR and Euro Yen TIBOR in Japan, and CDOR in Canada. Now, in other words, the regional significance requires a robust fallback to protect against risks that could occur if these rates ever cease to exist. And again, a precautionary step to make sure that the reformed IBORs do have a proper fallback methodology. Let me leave it there and see where we go.
Thanks, Scott. I think this is very useful information from the perspective of derivative markets, which basically sets the stage for other segments of the financial markets as well. Simonetta, let me turn to you again. As we mentioned earlier, the FSB is coordinating the global transition efforts through its official sector steering group. If we think about the size and geographical coverage of benchmark transition, such coordinations becomes very critical. And on June 2nd, the FSB published a package of important statements, which included critical messaging and guidance for the industry. Can you please elaborate on the purpose and scope of these statements?
Yes, thank you, Al. Sure. So in June, the FSB published a set of documents in one go, and these were all meant to support a smooth transition away from LIBOR by end of this year. So these papers, set of papers and statements have been developed in parallel with the progress report that we examined before, and to address the most pressing issues identified by the FSB official sector steering group through its market outreach, but also identified through the FSB BCBS survey of national authorities. These documents set out recommendations for financial and non-financial sector firms, as well as authorities. Let's see them in detail. So the first document is an updated global transition roadmap, which draws on national working groups' recommendations and summarizes the high-level steps firms will need to take now and over the course of 2021 to complete their transition. This roadmap is intended to inform those that have exposure to LIBOR of some of the key steps they should be taking to successfully mitigate transition risks. The roadmap has been updated to reflect the new dates of LIBOR cessation that are now formally confirmed. At the same time, the FSB recognizes that benchmark transition vary across regions. So legislation and other actions to promote transition are taking different paths in different jurisdictions. The FSB stresses the importance of an open and constructive LIBOR transition dialogue with domestic regulators, first and foremost, but also stresses the fact that firms should monitor developments with regard to other IBORs that are relevant to their businesses. This is the first document. The second document relates to one of the main transition challenges identified in the FSB survey, which, as I mentioned before, is the lack of forward-looking term rates for new risk-free rates. So the document speaks about the use of overnight risk-free rates and term rates. The FSB cautions market participants against waiting for the development of additional tools, in particular forward-looking term risk-free rates, although it recognizes that in some cases, especially for cash markets, there may be a role to play for term rates. So the FSB in this document sets out the circumstances where limited use of risk-free based term rates would be still compatible with financial stability. For example, if it is concentrated largely in certain cash products rather than derivatives markets, or used as fallback for these cash products. Then the third document, again to support transition in cash markets, is a statement of the use of ISDA spread adjustments in cash products, particularly in loan markets, which, as we have seen before, remains an area of concern with much new lending still linked to LIBOR. So the FSB worked closely with ISDA during the significant work program that ISDA undertook to strengthen contractual fallbacks. Following extensive stakeholder consultation, ISDA determined that the primary fallbacks for IBOR referencing derivatives would be the overnight risk-free rates identified by the relevant working groups, and that a static spread adjustment would be added to these overnight risk-free rates. The spread adjustments reflect the fact that IBORs are available in multiple tenors and incorporate bank credit premiums and other factors that overnight risk-free rates do not. So once the ISDA fallback protocol was published, the FSB strongly encouraged adherence to the protocol in order to avoid disruptions in covered derivatives contracts. The FSB statement, now published in June, recognizes that other products, not just derivatives, such as syndicated loans, for example, floating rate notes, corporate bonds, and so forth, also reference IBORs. They also require robust fallbacks, and national working groups in several LIBOR jurisdictions have endorsed the use of the ISDA spread adjustments in fallbacks for cash products. In this light, the FSB statement supports the use of the ISDA spread adjustments also for cash products that are to move from IBORs to overnight risk-free rates. The final and possibly most important statement encourages authorities to set globally consistent expectations that regulated entities should cease new use of US dollar LIBOR in line with the relevant timeline for that currency and regardless of where those trades are booked. As an example of effective coordination also amongst international organizations, as Alp you know well, IOSCO also published in parallel a statement on benchmark transition, which reiterates the importance of stopping the issuance of new contracts based on LIBOR. So it is critical that US dollar quotes published from January 2022 through June 2023 will only be used for legacy contracts. Use for US dollar LIBOR for new products after 2021 will create safety and soundness risks. This is clearly set out in the US supervisory guidance, and the FSB with its statement emphasized this message on a global scale. So the FSB encourages all global market participants to discontinue new use of US dollar LIBOR-linked contracts as soon as practicable, and no later than end 2021, in light of the safety and soundness risks associated with its continued use. So FSB members have agreed and will be reiterating these expectations to regulated firms in their own jurisdictions as appropriate to support this objective, which is very important for financial stability. Let me stop here, Alp.
Thanks very much, Simonetta. I think you very rightly mentioned the importance of stopping the issues of new contracts, as we mentioned also earlier. And in that sense, the coordination between the FSB and IOSCO was a good example of how international coordination should be and also considering the the amount of the emerging markets, as you also mentioned, the FSP and IOSCO probably have an advantageous position here, given the very broad outreach and memberships that we have, and also through your regional committees. So I think we should continue this coordination, globally speaking, among all the regulators and the international organizations. Now, turning again to Arthur. Arthur, we just give also a little bit the flavor in terms of the transition in Asia. We know that the main discussion was always between the both sides of the Atlantic, where the US and UK regulators and European regulators were involved in the discussion. But Asian markets are also equally important. For example, in our case as IOSCO, our Asia Pacific region or committee was the most active committee in benchmark discussions. They have some very important communication and coordination with European regulators, for example, on the outreach of European benchmark regulation. So there was always a request from Asian markets, for their questions and inquiries. And if you look at the transition in Asia, in your opinion, what are the supervisory challenges? And do you think Asian firms and regulators are ready for the transition? Here, I'd like to a little bit maybe bundle together Asian jurisdictions and also the wider population of the emerging markets and developing economies. Can you also let us know about the issues that are shared across the wider population of these countries?
Well, thanks for that question. Once again, before I answer the questions, maybe I should lay out the landscape of our survey, so the audience, when they read the FSP report, they understand this angle about EMDs and Asia EMDs in particular. I mentioned that we try to survey 96 jurisdictions, which are Basel Committee members, FSP jurisdictions, and FSP regional consultative groups jurisdictions. Out of that 96, 51 of those responded to our survey. And out of those 51 which responded, 25 of them belong to what we call EMDE. So about roughly half and half. Half of 26 actually advanced economies, and the other half, 25 of those are EMDEs. Out of those 25 EMDEs, 4 EMDEs came from Asia Pacific region. Not a lot. I just have to remind members that remember we surveyed 96, 51 came back with the responses. So there are 45 jurisdictions which chose not to take part in the survey. Most of those are actually EMDEs. Some of those actually from Asia. So the report actually covers part of the equations, but not everyone. As far as Asia regulators that have responded to our survey, as far as they are concerned, we generally observe that they are more aware about the situation compared with a year ago. Most Asian EMDEs have already taken part in monitoring the progress made by financial firms in pursuing the transition. They have actually also taken step in making sure that progress is made by the financial firms in doing that. Most Asian jurisdictions also make use of regional groupings. There is a grouping called EMIAP, the East Asian Executive Meetings of the East Asian and Pacific Central Banks. They use the platform to communicate on this particular subject of LIBOR transitions, to compare notes on what are the steps being taken and what are progress made in different jurisdictions. I think that's a helpful way of enhancing communication among different central banks and supervisors, financial firm supervisors. That's the awareness part of it. In terms of preparedness, we still see room for improvement in a number of jurisdictions. In particular, there are certain issues that was already mentioned in previous questions about potential sort of issues that they need to grapple with when they were pushing for transition. The lack of a term structure for risk-free rates. That has repeatedly been mentioned by Asian jurisdictions as a hurdle that needs to be overcome. But I think with the potential use of Easter spread for the cash market products, and also we saw progress made in developing the SOFR term rates, I think we would see the migration progress in Asia Pacific generally picking up in the second half of this year. Now, if I turn the attention to the wider EMDU groups, I have to say that generally speaking, they are less aware about the situation and less prepared for the transition. And this is particularly so in terms of two aspects. First, in terms of communicating timelines, supervisory expectations, supervisory requirements on timelines. That's the first part. The second issues that we are finding perhaps slightly lagging behind among the EMDEs are in terms of implementing the guidance issued by international bodies like the FSB in terms of transition progress. Some EMDs actually, in the context of our survey, actually told us that they have only just started the communications with the financial firms in terms of transition planning. A few actually mentioned that they haven't even started. I think they should really accelerate the action in those regards. Now, I have to say that part of the awareness issues that I was referring to could also be because those jurisdictions in the EMDEs are actually less exposed to LIBOR. I'll quote you some numbers here. Among the data that we have collected, some didn't actually provide the data to us, but among the data that we have collected in the follow-up survey, among the EMDEs, their exposures to LIBOR amounted to only 5% of the total exposures in terms of assets, 3% in terms of liabilities, and 1% in terms of derivatives. But one should also note that of those exposures that mature after end 2021, 9% of the assets, 25% of liabilities, and 7% of the derivatives have fallback options in place. So the significant part still do not have adequate fallback provisions in place. And also, as I've mentioned earlier, this result has to be interpreted with caution because a number of EMDEs did not actually provide inputs in that follow-up survey in terms of numbers, statistics and numbers. And so I think we have to continue to monitor this situation very closely. In terms of supervisory challenges in Asia, one interesting observations that came out from the survey, remember Asia Pacific region is a big host market for financial firms, in particular banks. And very often the Asian jurisdictions, whether it's AEs or EMDEs, are saying that how quickly the banks are migrating depends very much on how much attention the home, not just the authorities, but also the head office of those international financial firms, how much attention they're paying to the operations in Asia Pacific. And I think on that one, regulators in Asia Pacific region should communicate very closely with the home supervisors. And I'm glad to hear that, Alb, you mentioned ALSCO regional groups actually pushing very hard on making awareness sort of higher in EMDEs and Asia Pacific as well. On that one, actually, if you look at the FSB report, you see that the FSB regional consultative groups have already undertaken in the report to also engage and communicate with EMDEs more generally on this transition issue. I think that's a very helpful line of work in the next few months. We only have a few months left before the end of the year, so I think there is a big room for us to continue to push very hard in terms of raising awareness and preparedness for that. Thank you.
Thanks very much, Arthur. Very useful comments. And I think you're right that we really need a global approach and a holistic approach, you know, and if different jurisdictions or regions move in different paces, that may create really a lot of disruption. And in that sense, as you rightly mentioned, also FSB's regional groups and IOSCO's membership, these two are very broader. I mean, in comparison to other international organizations, I would say we have a broader membership, which may also be helpful for this objective. And as you said, we are doing our best on this by organizing different events and putting it in the agenda of each and every IOSCO meeting and using every occasion and conferences and committee meetings to that purpose. So yeah, I think we should pay specific attention to emerging markets. Now, and also the other point, sorry, I forgot to mention that the point that Simonetta made about the updated global transition map, I think that's a very important guidance to the firms all around the world in terms of what their next steps should be, and the time is ticking, so we don't have much time. We should act very quickly here. And turning to the FCA again, and Laure, so you know, again, this probably one of the hottest discussion is always about the tough legacy problem, and some of the contracts like bonds and securitizations are difficult to negotiate, and it's not like, you know, we don't have that big bang style transition tool as we have in the derivative markets thanks to ISDA. And we know that different jurisdictions and major jurisdictions like the UK, US, and Europe have come up with legislation. Or, for example, in the case of US, there's a federal legislative initiative now, and you were the pioneer for that as well. If you look at the details of those legislative efforts to provide safe harbor, they really vary in detail. But we would like to hear a little bit, if you could elaborate on the new legislation that will confer certain powers to the FCA in this context. And then, you know, again, coming to that point about scope of legislations being different and coverage also being different. For example, in the case of using synthetic LIBOR or not using it, how are the regulators coordinating on these issues in terms of, you know, all the details and in general as an international coordination?
Absolutely, Alp, a very hot topic, as you say, and for some time now, I think authorities have understood and recognized the problem of tough legacy contracts. I think you refer to that term yourself, and whilst there isn't an exact definition for tough legacy, we consider it to be those contracts that it is not practicable to convert before the announced cessation dates for LIBOR. As you say, in the UK, the government has granted the FCA new powers to help ensure an orderly wind down of LIBOR, which can help reduce disruption to holders of those tough legacy contracts. In our 5th of March announcement I mentioned earlier, we provided clarity on when the LIBOR panels will cease. And for most LIBOR rates, the end of the LIBOR panels means the end of publication altogether. But we also said that we saw a reason to propose a different path in relation to 1 month, 3 month, and 6 months sterling and yen LIBOR settings using our new powers. We're consulting on using these powers to implement this synthetic LIBOR solution, which would act as a temporary safety net for tough legacy contracts. This would involve us requiring the producer of LIBOR to continue publishing a rate, but using a different methodology to the one they are currently using. This is being done very much with the intention of protecting market integrity by ensuring these tough legacy contracts continue to function after the LIBOR panels end. We're proposing that these synthetic LIBOR rates would be calculated using forward-looking term risk-free rates that are based on overnight index swaps. That would be TONA for yen LIBOR and SONIA for sterling, plus the relevant ISDA spread adjustments. And you can expect any final decisions about using these powers to be delivered in Q4 this year, as soon as we can. We are also keeping under review whether it will be desirable and feasible to require the publication of a synthetic US dollar LIBOR rate to help with legacy contracts there. Obviously, those that won't have been able to transition despite the extra 18 months for the dollar panels. So no one really should rely on that happening. This is something that we will have to decide nearer the time. But it's really important to remember that where parties can practically agree to convert their contracts on the fair terms that have now become standard across derivatives, securities, and loan markets, they should do so, because any synthetic LIBOR would only be a time-limited solution. And indeed, we have said that we intend to compel publication of any synthetic yen LIBOR rates for 1 year only until end 2022. And this is intended to allow more time to complete transition of tough legacy contracts. So you should continue to focus on agreeing with your counterparty to change your LIBOR contracts to alternative rates. As Arthur mentioned, and I think you alluded to, Alp, as well, other authorities have also taken steps to put in place legislation for tough legacy contracts. And obviously, Arthur pointed out the importance of international coordination on these legislative solutions. It is very important. And our key message for those following these developments, such as in the UK, the US, the EU, and asking how they fit together, is to be reassured that we, along with other authorities, have been cooperating closely and will continue to do so. We all agree that contractual governing law clauses should prevail and that we should not seek to override solutions written into the contractual governing law. We are aware of the benefits of alignment, that is, where legislative solutions point to the same replacement rate, notably in the wholesale space, which is very international and cross-border in nature. That said, there may be some differentiation, but where this happens, it will be a conscious choice where there are clear advantages to deviate for a particular product in a particular jurisdiction. For example, the approach that the ARC has taken to its recommended fallbacks for consumer products. We also see no downside to encouraging other jurisdictions to legislate their own solutions for contracts covered by the national law, particularly to provide contractual continuity and minimize litigation risk. From the very beginning, this transition has involved international coordination. It is very clear from the event today, through your remarks, Simonetta's remarks, Arthur's remarks, and Scott's as well, through the Financial Stability Board and IOSCO. And this will certainly continue over the months to come as those legislative solutions are put together and implemented.
Excellent. Thanks very much. And now, Scott, if we turn to the derivatives markets again, more like my question would be from what can be extracted from the derivatives experience and used in other segments of the markets that are struggling with the transition, especially in the case of cash markets. As you know, and we mentioned, ISDA spreads are also recommended for cash markets. And based on your experience in derivative markets, what can you recommend for these other market segments in this transition?
Well, I think firms need to think about moving to alternative rates for new trades by the end of this year. It's the timetable that they really need to be thinking about. Even though 5 US dollar LIBOR settings will continue to be published until mid-2023, the much discussed no new LIBOR after 2021 is going to be a huge factor in how people think about this. So you really don't have time to think about, that this is continuing on. We're just, as Anna-Laura mentioned, managing the tail risk, those legacy contracts that are still have not been changed yet. So for new contracts, think about, looking up the new rates. Firms should really begin thinking about, or they should be thinking about having milestones in place for the coming months to put into systems and processes to use the alternative rates for new trades. As was mentioned, the CFTC's Market Risk Advisory, the Sterling Risk-Free Rate, and the ARC have all made very, very strong views around transitioning to risk-free rates and the new steps around incentivizing SOFR past July of 26, which is just a few weeks away in terms of a SOFR first strategy. So there's a very strong concerted push by regulators around the world to really drive trading into these new risk-free rates. You don't want to be the last one to kind of figure out where you're going to trade and what rate you want to use. So institutions really need to be thinking about having that active transition plan of their portfolios. Having those fallbacks in place is very important, of course, as a first step. In terms of spreads to cash markets, I don't think people are going to get high marks for creativity here. So I think people are going to be using the very same spread adjustments and fallback methodologies that we've used in derivatives should be applied to cash markets as well, to understand those spread adjustments that are based on clear, transparent methodologies. We did this in development with the market, so market participants are very aware of what's going on and what they were headed into when we first consulted on these rates almost a year ago now. So having those indicative spread adjustments and all-in fallback rates published on Bloomberg today, so anybody can go look at those and begin to think about what the spread adjustments will mean for them and their portfolios. Overall, I think market participants would prefer to have a consistent set of spread adjustments rather than various types of calculations for different products. Therefore, I think that speaks to moving to a very consistent RFR fallback and new term and the new rates for trading. And going forward from a purely derivative standpoint, we are in the process, as I noted earlier, of helping other jurisdictions, some of these other currencies, transition and have fallbacks in their currencies as well, to create that same level of consistency of the main currencies as well as other important regional currencies, Philippines, Thailand, New Zealand, et cetera, that I mentioned earlier. And we'll be consulting on those and implementing those new fallbacks in the very near term.
Very good. Thank you very much. I think all these have been very, very comprehensive, and also now gave us clear ideas about, what about the pending issues and the immediate steps that firms need to take in various segments of financial markets. So as a brief final question to all of you, what would be your key message in this benchmark transition? If you can, mention that with one or two sentences, we would appreciate very much.
So my key message, as you can imagine easily, Alp, is on the importance of international collaboration to ensure smooth transition across all currencies, markets, and geographies. When you think about this, all currencies, markets, and geographies, this is a daunting task. And given the massive size of the transition, regulators and international bodies should coordinate in their timelines and messages to firms. And this is in order to avoid market disruption and achieve the transition without a delay. In this context, the FSB, like IOSCO, will continue to play an important role. The FSB provides a forum for authorities to continue to monitor an effective transition away from LIBOR, but at the same time be open on remaining challenges and coordinate the supervisory messages to regulated entities, and through them also to non-financial institutions and other end users, in order to facilitate transition to the more robust benchmarks that serve financial stability.
One or two sentences is tough. I think I've heard the word act mentioned many times during this session. So I would just say act now and accelerate. Act meaning accelerate A, C stands for, I think, communicate, and T stands for transition targets, really. They should really set clear targets for themselves. So I think they should really start taking concrete actions to pursue meaningful progress in the next few months, because we're only a few months away from the end of the year.
Thanks very much, Arthur. If you don't mind, I'm going to use this ACT message in other meetings as well. I think that was very creative. Thank you very much. And Lord, what is your key message?
I don't think I can beat Arthur's ACT message, but absolutely the time to act is now. And I'm conscious that the end of the LIBOR panels is a matter of months away. And either if you're a regulator, you want to make sure that your regulated firms have robust plans in place. And if you're a firm, you absolutely do not want to be leaving your transition till the last minute. I'm sure that many firms have already started this process, but if you haven't already, you need to begin discussions with your counterparties now. So I think in a nutshell, with just under 6 months away from the end of LIBOR as we know it, it is quite simple. You need to act now.
Okay. Scott, what is your core message?
Well, I'm going to endorse everything my fellow panelists have said, but I would also make sure people look at the operational challenges as well. The systems that you have to manage, making sure your contracts reference the appropriate reference rates and fallbacks, making sure that you have identified LIBOR in all of its forms wherever it exists in your organization and in your portfolio, and begin to address it. And I think from a system standpoint, just literally the operations and systems referencing these rates and doing the computations for risk purposes, also very important to pay attention to.
Right. Thanks very much to all of you. Conscious of time, I would like to thank you all very much, and you have provided us with very useful feedback, and it was particularly important to hear these from you. You have provided with clear messages, next steps, and importantly, very clear expectations from the financial industry in this challenging task. And now we have a very clear idea about what is waiting for us in 2021 and beyond that. Apparently, the transition efforts will continue for a couple of years more, but we hope that at the end soon we'll end up with a very sound benchmarks world, which are also in line with the IOSCO benchmark principles. So thank you all very much for your time and for your very useful insights and the feedback that you have provided to all of us. Thanks.